Hello, I'm Lucian Cook. I'm head of residential research at Savills, and my job is to monitor what's going on in the property market and what we think might happen. For me, there has been a pretty interesting and busy time over the last week or so because we've had a whole succession of proposals floated in the press around the taxation of high value property, and we thought that you as our clients would benefit from some of our insight in that. We might not be able to give you all of the answers, but hopefully we can fill in some of the gaps in your knowledge and give you some advice as to how to think about proceeding. So let's go into some of the detail. If we start off, then I think the first thing to say and to be absolutely clear about is that all of the rumoured proposals that we've heard about or read about in the press are currently in draft form only. They are not firm proposals to be included within the budget. But given the sheer number of those proposals that we've seen, we're beginning to get an indication that the government is really looking to test the water to see what the response is to their proposals to help them decide how to proceed when it comes to the late autumn. Given that these are all draft, given that they're all rumoured, of course, it makes it very difficult for either myself or any of our agents to give anybody categorical advice on how to proceed. And that means that at the end of the day, it is going to be a position where you, as buyers and sellers in the market, make a judgment call. What we would like you to do, or what we would like to do, is to make sure you're in the best possible position to make that judgment call. Because of the changes that we've seen, we know that some buyers are going to be looking perhaps to delay any transaction. So if stamp duty land tax is abolished, they can avoid it completely. But we also know that some sellers may be looking to act fast, to go the other way, to avoid the imposition of capital gains tax on properties worth £1.5 million if that is introduced. And of course, there we have some competing objectives between buyers and sellers. But it's worth noting that in those circumstances, it isn't always clear-cut as to how different parties are likely to act. And in that respect, I think it is worth being aware of, if you are a buyer, exactly the position of your seller. If you're a seller, what the position of your buyer is. And actually for both parties to get independent professional tax advice as to how they might be affected, given what we know is being considered, at least by government. So I wanted to start off by just looking at this from a government perspective. I think this sort of sets the context as to how the government will be thinking and how they may act once they have seen the reaction to all of these proposals. And it's worth noting that given that we have a public financing deficit, their number one objective is likely to be to generate additional tax revenues. Anything which risks failing to do so, I think, is going to hit the cutting room floor. There are some secondary objectives alongside that. I think that revenue generation is clearly top of the tree. The first of those is to minimise disruption to the housing market. Why? Because they have ambitious plans, for example, around housing delivery. They don't want to disrupt the housing market. It is also a very strong barometer or influencer of confidence and therefore can have a wider economic impact. In the third instance, we do know that they will look to place the burden on those with the broadest shoulders, and hence we're seeing that focus on the top end of the property market. But with that in mind, any government will be keen to make sure that whatever they do is done in as fair and equitable manner as possible, so that the criticism that comes their way is minimised. So against that context, we have the first of the proposals to look at. This is that which has been floated in the media about replacing stamp duty land tax with an annual property tax over £500,000. And these are the things that we think we have learnt about that. In the first instance, it assumes that some of the stamp duty land tax surcharges would remain. So the surcharge for overseas buyers and those buying an additional home are essentially in place for political purposes. We think those are likely to remain. So what we're looking at is removing the main rate of stamp duty and replacing that with an annual tax. And if that's the case, the government will be looking to make up for at least 8.1 billion in existing tax revenues. The way they would look to do that is an annual property tax. The expectation from the proposals that were originally floated by a think tank called Onward was that it would be on properties over £500,000, and it would really apply just as and when those properties transacted. The charges, just over 0.5% of the value per annum on the value between 500,000 and £1 million, and a figure that is 50% higher than that, so around 0.8% on the value in excess of 1 million. And we're going to have a look at what that means in annual charges a little bit later. The difficulty with that, particularly if you introduce this gradually as and when properties transact, is that in year one, it would only generate revenues of around 500 to 550 million by reference to our calculations. And that would mean it could take up to 15 years before the annual receipts hit the 8.1 billion. On that basis, it really would, as drafted, fail or fall at the first hurdle. So, what might change? Well, actually, if this was combined with an overhaul of council tax, and we'll have a look at this later, it might be more palatable. If that's not the case, then you would really need to apply those new annual charges to all privately owned properties if you were to get yourself to a break-even position sitting there behind your desk at the Treasury. But to meet that criteria, that real requirement, to be as fair and equitable as possible, there would be significant lobbying and I think significant disappointment if it weren't the case that you had some relief for those people who have paid stamp duty land tax in the relatively recent past. Whether that's 5 years previous or 10 years previous or any other period is really open to conjecture. But I think there would be significant kickback were that not to be the case. Thinking then a little bit about those people who are in the market, I suppose the main concern amongst prospective buyers is that they could end up being taxed twice. So if they undertake the transaction prior to budget day, they pay the stamp duty land tax. They need to be sure that they would get some relief from that. If not, they would also be liable to the annual charges. And I think just that inequity, that inherent unfairness means that any introduction of this sort, there would be an incredibly strong case to make sure some credit is given around previous stamp duty land tax payments. Once it's introduced, we can have a bit of a think about the impact on the market by really comparing the relative position for different people who are buying. Clearly, for anybody who is buying above £500,000, who wouldn't be caught by these annual charges and would be avoiding stamp duty land tax, it's a good thing. What we can do is look at underlying rates of stamp duty for all of those price bands, so ranging from £17,500 for a property worth £550,000 right up to just shy of £515,000 for somebody buying a £5 million property. And we can compare that to the annual charges that we think, on the basis of what we know, would apply. So this is on the assumption that you pay that rate of 0.54% on the value between 500,000 and £1 million, and that 0.81% above £1 million. And you can see the charges there ranging from 270,000 to 36,450 for that £5 million plus property. What I suppose is interesting then is if you want to get a measure as to who wins and who loses within these price brackets, is to look at what one is as a multiplier of the other. So this is the years of ownership equivalent essentially to pay the equivalent level of stamp duty land tax. And that's right up at just short of 65 years for that £550,000 purchase. It falls right down to around 11.6 or about 11 and a half years at 1.5 million, and then rises back up again as you go back up through the price bands when you start to consider the way that stamp duty is currently structured. We can look at it in another way, which perhaps is, what does that mean in terms of the risk to property values? And of course, somebody buying at the moment will wish to be aware of where those risks sit. So we can look at those underlying charges for stamp duty. We can compare those to, if you like, the capital value or the equivalent sum today, which the future exposure to those annual taxes might create. And we do that by multiplying it at a discount rate. In this case, we've chosen 3.5% over an appropriate period. And in this case, we've chosen 20 years of ownership. And when we start to compare those figures, you can see, in essence, you are better off right up until £1 million. And whilst you're worse off above 1.5 million on the basis of these examples, the figures are not necessarily that significant in comparison to the total value of the property. So we don't believe that if the change were implemented in the way that has been floated, this would necessarily be a huge threat to property values over the longer term. The question, though, I suppose that comes from that is, that's great and fantastic. We know, Lucian, though, and you've told us that there is this risk, at least, that this is linked to some form of council tax reform. So we wanted to try and put the risk of that into some context, and hopefully you will find the following useful and interesting. So here we are with some monopoly houses and a council tax bill. First point to make is that there is very little doubt that on any measure a council tax revaluation is overdue. The distribution of the tax is based on 1991 values. That is a very long time ago by anybody's measure. It's even before I started working in the industry. But equally, even if you were to undertake that valuation, that wouldn't necessarily result in increased liabilities across the board. And that really is because council tax is set at a local, not a national level, and it is set according to local funding requirements of each local authority. It is, of course, subject to some caps on increases from central government, but this is really a means of distributing the local funding requirement for local authorities. So you will always have differences between one local authority and another. What it would do, of course, is redistribute the bills within a local authority, but it wouldn't necessarily result in a cash positive position. And even in a world of automated valuation models where you can get to the values much more quickly than you could, say, in 1991, it would still be relatively costly, and assuming there would be a right of appeal, it could be relatively bureaucratic. As a challenge to the market, that challenge, of course, would be much more significant if we ended up with a uniform rate of tax that is much more directly linked to property values. But that has some significant disadvantages from a central government perspective. In essence, it would mean that you move from a locally administered to a nationally administered tax. That would break the link between with accountability for local authority spending, and it would completely drive a coach and horses through the way that local authority finances are run. So on that basis, I think it would be a very bold move by any government, and it might mean that instead you end up with more of a tinkering of the council tax system. There is no indication that the government would do this, but one way that perhaps they might do that is add some additional council tax bands at the top end, have some uniform rates just for those bands, and ring fence some of the receipts, passing those back to central government. It's an option, it seems relatively sensible, but it is at the moment just conjecture. So those are, if you like, the first two of the options. I wanted to move on to the third of those, and this has been loosely described in the media as a mansion tax, but it differs very significantly from the mansion tax proposals that I found myself discussing in the early 2010s, because it is really just removing or the proposal to remove private residence relief from capital gains tax on properties worth more than £1.5 million. So let's get in and have a bit of a look at some of that detail. Where, of course, it creates some issues is, firstly, sellers may want to accelerate a transaction if they feel that they can do so and avoid some capital gains tax. And for those people who can't accelerate that transaction, it may just make them a bit more reticent about selling and indeed moving. But before anybody makes that decision, they will want to understand how this applies to them and whether they are likely to make a capital gain. And in many circumstances, that is far from clear cut. So if we have a look at the capital gains and how capital gains are calculated in its purest form, this comes from Investopedia. A capital gain is the increase in the value of an asset relative to the price that was originally paid for it. But of course, with all taxes, there are some nuances in how this is applied to the capital gains tax regime. So in the first instance, you start with sale proceeds net of costs of sale. And of course, those will include things such as agents' fees and solicitors' fees on the sale. In addition to that, you would deduct the purchase price, or if you've owned the property since before 1982, generally the 1982 value. Where you, in the most cases, are deducting that purchase price, there's a few important things to note. You would also be able to make a deduction for the associated costs of purchases, including, crucially importantly, the stamp duty land tax that you paid when you bought the property. And as we know, in many cases, that stamp duty land tax is quite a significant figure. All of that together with a relative lack of capital appreciation over the period of the last 10 years or so is likely to minimise the gains that people face, or mean in a number of cases they would be creating a capital loss. Where they create a capital gain, then currently the highest rate of capital gains tax that they would pay is at 24%. And even in getting to that figure, they would also be able to have made their deduction to arrive at the gain for any improvement expenditure that they might have undertaken on the property, whether that's an extension, whether that is a significant refurbishment, whatever the case may be. So we've taken that and we've done a little bit of modelling. We've looked at the theoretical position of a property, for example, in prime central London worth £4.5 million at today's date. And you can see here the capital gains that would result, or the capital losses that would be generated in those circumstances. When you look at that prime central London market, where prices are still 22% below where they were in 2014, that would mean that you would essentially be generating losses for the average property bought since June 2010. And there may be some extreme circumstances where some taxpayers want to crystallise that loss to offset against gains that they've made on other assets, that further depleting the net tax revenues which the government would receive. We can also compare that to other parts of the prime market. So we've run the same exercise for other prime London properties that sit outside of that rarefied central London area, properties there worth 2 million. And again, for the prime regional markets, again, you can see some fairly substantial periods in here where no gain is being generated or capital losses are being generated. Indeed, in the case of the other prime London markets, on average, that is losses for anything bought since September 2013. And in the regional markets, it's a little bit later. You've got a slightly shorter window. That is since March 2016. To put that into another context, you can see here how much at that 24% tax rate those charges would take up as a proportion of the sale price. And that really varies between 5% in the prime regional markets to 11% in the outer prime London markets and 10% within prime central London. And those figures, whilst they are reasonably sizable, are not nearly as large as many people might perhaps assume. And I think it's for that reason that we would really recommend to people that if they are concerned about this, they should get their tax advisor to work out what their capital gain might be before they make any decisions to determine whether or not they are significantly affected by these proposals. So where does that leave us on this particular measure? Well, what we know is that the ability to raise revenue from a government perspective is going to be limited by the number of people who are likely to be sitting on capital losses. We also know that for those who are bearing a gain, they may be less inclined to transact. That, of course, also then reduces the prospective revenue that can be raised by government through these measures. All of that means that it sort of raises the questions as whether it's really worth the hassle from a government perspective. I think from the perspective of you, our clients, I think if you have got concerns as to how much you might be exposed to were this to occur, then you should be getting some advice from an appropriately qualified tax advisor, and that should enable you to make that informed judgment call as how to proceed. So there we are. That's largely me done. What I'm going to finish with is a little bit of a warning, and that goes right back to the beginning of this presentation. There really is no guarantee that any of the proposals that have been floated will be in the budget or in the budget of their existing form. Nonetheless, we very much hope that this means that you are better informed and therefore better able to make your property decisions. That's me done. Thank you very much for giving me your time. I hope you found it useful.